Good morning, everybody. You're watching SmallCapSteve Live. I'm SmallCapSteve. We got a big show today. We got Marc, Chandler joining us. It's Thursday, April 8th. The S&P 500 hit an all-time high. We got a debate going on right now with some global leaders over the global economy. So that's going to be all over the news. Gold is up. Gold's having a pretty good morning. Biden is sounding like he's willing to negotiate a little bit on corporate tax rates, which we're obviously all over the headlines. So buckle up. Let's get started. Marc, thanks so much for joining us today.
Great. Thanks a lot for having me.
We were talking a bit during the pre-interview, and it sounds like you are somebody who I am really excited to talk to, because I've never actually met anybody who's managed to make it as a foreign exchange trader or analyst long-term. And I was saying to you that beforehand, I've met a lot of people who tell me that they're doing it, and then it's like, I see them 2 years later and they're never now look, I'm talking to a lot of retail people. I don't talk to a lot of institutional types. So maybe if we could just start with your background of how you got into the trading currencies, and then secondly, why is it so challenging for retail investors to try to make a go at it?
Yeah, sure. So I have a very unusual background. You know, most people who have my kind of job have their MBA or undergraduate degree in economics. I didn't do any of that kind of stuff. As an undergraduate, I majored in what they called humanities, which was philosophy, religion, and history, and political science. I then went on to get a master's in American history, and that's where I learned economics was really in the context of history. And American history, if you bring it up to, say, 20th century, it naturally takes you into international relations. And so I did another master's in international political economy. And my first job out of school was actually on the floor of the Chicago Mercantile Exchange for a newswire, covering the currency futures and the T-bill Eurodollar futures. Before I was as a journalist. And then I found that the markets reward people not necessarily for being right, because as you know, most of those large equity fund managers don't beat the market consistently. But the market's reward, at least in some element, is people who have an opinion. And so that's why I ended up moving from the journalist side to the analytics side, where I've really spent my career helping primarily large funds, large companies, and the, say, ultra high net worth individuals.
Okay, so why do you think it's so challenging for retail investors to actually make a living trading the foreign exchange markets?
Well, I think that the challenge is a couple things. One is that the information set we need is much bigger than you need for an equity or for a bond market. An equity, you'd study the company, perhaps. Maybe you'd study the industry. Maybe you'd study maybe the U.S. equity market versus another equity market. But there seems to be a limited number of variables. Well, all those variables plus more affect the currency market. So one is just the amount of information one has to have a handle on. Secondly, for the most part, U.S. equities trade during U.S. hours, right? I know the futures don't, but for the most part, individual equities do. Currencies are a 24-hour-a-day market. My week begins Sunday afternoon when Australia and New Zealand open up, and it doesn't end until Friday, about 5 o'clock. And so that is the 24-hour-a-day, say 5.5, 6 days a week. And so I think that's also challenging, because what happens is that moves take place while Americans are sleeping. Many of my friends think that the sun rises and sets on the United States, but the foreign exchange market knows different. By the time that the U.S. market is up and running, over half the day is over for the foreign exchange market. And the third thing I'd say about why the foreign exchange market is challenging is because the pools of capital are huge. You're battling wits against central banks, against large companies, asset managers, hedge funds, speculators, which some could be larger than companies. And so I was comparing it to playing a poker, watching these World Series of poker on TV. The person who got the small stack at the table is at a disadvantage. Retail has a small stack. And so I think they're at a disadvantage because the market is just so big and the information and the analytic processing is so challenging that I think that retail is a special disadvantage there.
So I've got literally 1,000 questions based on that. That's great. We've never had someone that focuses on foreign exchange on, so I've got so many questions. So do you then primarily focus on trading world events or the opposite of that? Like, for instance, what's going on in China with Taiwan or Russia and Ukraine? Do you trade around global events like that and go, oh, hey, I can probably get an edge here? Or is it like most things where once that happens, it's already too late?
Yeah, no, you're right. I think that there's of course, same thing with equities, right? You have 2 or 3 different investors and you have 2 or 3 different ways that they would try to skin the cat. My approach has been as really learning from the retail traders on the floor of the Chicago Mercantile Exchange that trading is so difficult that I need to have a lot of tools in my kit. That includes technical analysis. It also includes geopolitical analysis. In my commentary today, I was specifically talking about what was happening with the escalation of tensions in Taiwan and China and the U.S. Of course, it's sort of a strange dance of the 3 of us. But I think that for me, the geopolitical context, I'm trying to anticipate. And that's what I think is so great about the markets. One of the functions is really about anticipating future developments. And so I think that a lot goes into that. But I think that geopolitics is an important element there that sort of gives us the contours of the investment climate.
So how do you go about anticipating that? I mean, I've got 1,000 ideas in my head about how you would do it. Like, do you go on obscure websites and look for on-the-ground people that are tracking things? Like, growing up, there was a conspiracy website called Godlike Productions that kind of followed, hey, there's a train moving all this equipment here. There might be some event set to happen in Eastern Europe as a result, stuff like that. So do you watch that, or do you just solely focus on macro and just kind of play it by best guess?
Well, it's interesting. I would say that what I think people like in my position, people who like me in the industry, we're news junkies. I think that how far out we go into like the undisclosed or rumor websites, how much people use, say, a zero hedge website. I think all that varies from like personality type to. But I do think that for me I think a couple of things. One is I try to read a lot of things, and most things I read I don't agree with. But that's good, and I think that's the danger of what's happening now is that we tend to gravitate to sources that sort of reaffirms our priors. So if you're a Trump supporter, maybe you liked Fox TV. If you liked Biden, maybe you watch MSNBC. What I try to do is try to sort of cast a wide net, but it's primarily known sources. But I do think that having that background, I think it's those news sources are the tip of the iceberg that's above water. What I'm looking at is understanding politics, understanding history, understanding that today, for example, is an anniversary of when Truman basically took over, nationalized the steel companies in the United States. Truman nationalizing the steel industry to prevent a strike. And now I think about how far we've come as Powell's talking, as we speak now. Powell's talking, and he's really redefined, right? The Fed's mandate. We used to call it full employment, and now it's maximum and inclusive employment. So I think understanding, on my computer, I set my cursor so I can see a trail. And I do that partly as I get older, it's easier on my eyes, but partly I think that's the way life really is. That to understand the present, you have to understand the past. And I think that a lot of my colleagues who studied economics, thinking that economics is about supply-demand curves and economic formulas, and the MBA students who can tell us the present value of things, I find that by lacking the historical context, they miss a big piece of what's going on.
That's interesting. So let's get into some of the current events that are happening right now. So we've got Janet Yellen is, she's approaching, I don't know, she's approaching other countries, but she's talking this rhetoric that the world should be looking at sort of a minimum global corporate tax rate. You think that there's any way that that's possible?
Well, I do think that there's a lot of talk about it. And for me, it's not coincidental that the same moment in time where the Biden administration is talking about hiking the corporate tax rate, basically repealing the 2017 tax cut that went from like 35% for corporates to 21%, that the government, that the U.S. doesn't want other countries to undercut us, so they want to raise their minimum tax as well. The trick to it, though, is my point would be something like this, that if there is a global minimum tax, we're going to see a cottage industry of lawyers and accountants working on carve-outs. For example, when Biden first talked about this minimum tax, during the campaign, he was talking about companies that had revenue over $100 million. Now, as it's being presented to the international public, he's talking about companies with over $2 billion in revenue. So how many companies are we really talking about in the U.S. that would be subject to the minimum tax? The U.S. Treasury Department says less than 4 dozen. So I think that we've got to be careful when we think about taxes, especially if you're thinking about the difference between the tax schedule, sort of what Uncle Sam says, the percentages for your income level, versus the effective tax rate. And the effective tax rate includes all those loopholes and all those exemptions that one can take, which is why something like 10% of the S&P 500 companies didn't pay taxes last year. I think it's harder to play internationally, and the idea that there could be an agreement by the end of June seems to me to be quite a stretch. Even today, the Swiss, who have low corporate taxes, have suggested that they think it's next to impossible to get an agreement this soon. I think it'll be a great coup for the U.S. Treasury, for Yellen, for the U.S. to have the global agreement on a minimum tax, but I'd like to see it to be more comprehensive. But we'll have to see how it plays out.
Do you not get concerned that like the whole political system these days, with everything that's been happening, with sort of, we see the marriage of the Fed and the Treasury get tighter and tighter every year, it seems, that instead of this debate being about taxes, it's just going to turn to, oh, well, we can't raise the tax rate because it's going to hurt jobs and we want the economy, as you said, maximum employment. And it just turns into, well, the easy decision just seems to be, well, let's just print more money and take on more debt. And the reason that I'm so interested in asking you that question is that you follow the currency markets. What impact will that ultimately have if they end up saying, leave the tax rates where they are, let's just take on more debt and have the Fed cover it?
Well, yeah, it's a possibility, because I think you're right that the compromise traditionally has been, instead of the Solomon sort of type of solution of cutting the baby in half, instead both sides get what they want. The Republicans get low taxes and the Democrats get their social spending. I wonder, though, if I think that for me, the key to what's happening right now in the foreign exchange market, and why the dollar has begun this 2021 on a fairly firm note, is really comes down to one word, and that's divergence. A few countries can keep up with the U.S. in terms of its will on monetary policy, fiscal policy, and I know the rollout of the vaccine was slow in the beginning, but it is really accelerating. These three things put us like head and shoulders above most other countries. In the short run, like it has been in Q1, it's been good for the dollar. And there might be a little bit more life left in it. But I think that the next big theme, if you will, is the opposite. That is, this divergence is not going to last forever. Now, take a look at the German rollout of the vaccine, too. They began off slowly, and I think that today or yesterday, they're hitting record numbers of people getting vaccinated. So I think that the slowness that Europe has had to roll out the vaccine, some other problems they've had with fiscal policy, will be is really baked in the cake. and will be changing as this year progresses. So I think the divergence theme is going to come to an end, and we'll begin talking about convergence. But in the short run, this divergence, good for the dollar. But here's why I think it's going to be negative for the dollar. I think it dovetails on what you're saying too. Is the market seems to me, the foreign exchange market seems to move like between two pillars or two axes, if you will. One is widening interest rate differentials, good for the dollar. The other side of as the axis swings the other way, I think that it focuses on what we call the twin deficits. Most countries have budget deficits. The U.S. is rare because the U.S., all of our debt is in the U.S. dollars, and most of it is owned domestically. Give me the Federal Reserve and Social Security, and I could show you the bulk of the U.S. debt, especially compared to foreign ownership. But I think that the issue of the debt in the U.S., we got this budget deficit, but also, unlike China, Europe, we have a trade deficit. Broadly speaking, we call it the current account deficit. And these twin deficits require capital to fund them. And we get a lot of that capital from overseas. Traditionally, U.S. has to offer a higher interest rate to suck into capital, higher interest rate or better returns on capital. And I think that when this divergence theme ends, convergence comes back, the market will be left long U.S. dollars, and at a time where the interest rate differential no longer is wide enough to bring in more money. So what I'm concerned about then is that after this divergence story plays out, we'll go back and look at the twin deficits and say the dollar needs to be weaker.
Mm-hmm. So I just brought up a chart on that, and that's such a thought-provoking and interesting idea. This whole concept of how can you run a deficit in terms of this is my understanding of a twin deficit of locally or on your country level, you're running a national deficit, but then you're also running a deficit with other countries in terms of trade. So we kind of look at the U.S. here, and it's sort of like it's been like this for a long time. Basically, the last time it looks like the U.S. even was positive in the trade category, we got to go to it looks like 1990, 1991.
And that was a bit of a fluke too, because that's what you're looking at the current account. And what happened was every so often. So here's what happens: U.S. multinationals put their profits through different accounting mechanisms. They put it offshore, and if they repatriate to the U.S., they pay a higher tax rate. And so every so often, the U.S. politicians decide to give them a tax holiday so they can bring the money back. When they bring the money back, that shows up in the U.S. current account. But broadly speaking, the U.S. has been running a current account deficit since the early 1980s. And here's what's happening now. So partly, the U.S., by this fiscal expansion, the stimulus, that means the U.S. economy is going to grow faster than most other countries. When the U.S. economy grows faster, a lot of our product stays here. We're consuming it. And we're consuming product from overseas. So, for example, this infrastructure project that the administration's proposed, where is the U.S. going to get the copper, the asphalt, the steel, as an example, from? We're going to be importing that. Essentially, the growth differentials favor slower U.S. exports and more U.S. imports. So just yesterday, when we saw the U.S. February trade balance, it was a record deficit. And I think that's a sign of more to come.
So what's holding up the U.S. dollar? Like, you'd think, like, if you just keep printing more money and you keep going further into debt, but from like a international standpoint, you keep taking more goods and services from other countries than you're giving back, you'd assume that at some point your dollar is going to weaken and nobody's going to want it. But here the U.S. dollar seems to constantly remain so strong. What's the reasoning for that?
Well, I think if we were playing poker and you told me I can have China's cards, I can have Europe's cards, I can have the U.S. cards, I take the U.S. cards despite these twin deficits. You know, one of the amazing thing is, as we sit here today, there's about $13 trillion of bonds with a negative yield, either in Europe and in Japan. So to give up on the U.S. dollar, which partly means these large pools of capital, they just don't hold on to dollars, they hold on to U.S. Treasury bonds. Mm-hmm. And to give up the Treasury bond, like Russia has been, because of a lot of sanctions against Russia, they have been really blocked from the U.S. banking system, which means to be blocked from the U.S. dollar. So what they've done is they're buying more gold and they're buying other countries' bonds. To buy other countries' bonds means you're going to be giving up yield, transparency, security, liquidity, and yield. And so I think that what keeps the dollar up is that the U.S., when everything is said and done, it's still the world's largest economy. Its growth is incredible. It's got the commanding heights. I mean, think about like the internet that we're using now. I know Al Gore made some kind of claim about he helped sponsor it or invent it or anything, but this is amazing. And you think about companies like, and I don't know if it's not like necessarily that I like these companies, but they are the commanding heights. Facebook, Amazon, Apple, the list of these, like maybe it's the FANGs, but the idea is that it seems to me that besides China, Europe doesn't have these, Japan doesn't have these, and so I think that the financial innovativeness of the U.S. I think that there's a lot of good reasons to be in the U.S. and I know that as equity guys, you appreciate too that U.S. stocks traditionally outperform Europe and Japan. Though this year, or I should say, at the end of last year, Japanese stocks rose to their best levels since the early 1990s.
Huh.
So I have to ask then, because Steve pretty well led us to the question. What's your take on the U.S. as a reserve currency? There's a lot of people thinking that it's going to be lost in the next, call it 50 years. Do you take that stance or do you disregard that entirely?
It's funny you ask me about such a long term. I don't even know what I'm eating for dinner tonight. But in fairness, I think that to me, there's a couple things. We all use the same keyboard, QWERTY. Mm-hmm. Now, I'm told that there are better, more efficient keyboards out there. So the first thing, the reason we use QWERTY is because that's what we're used to. There's inertia. So that's one thing the dollar has in its favor. The second thing the dollar has in its favor, like I mentioned, is the U.S. Treasury bond market. But does Europe have a bond market? Not really. The Germans have a bond market. The French have a bond market. Italy has a bond market. But those are more like the U.S. muni market. Small, basically very fragmented, and each country has its own rules. And so think about when the U.S. auction has an auction. We haven't had a coupon auction for a couple of weeks now, which might help explain why U.S. yields have drifted lower. But when we have these coupon sales, we're talking about $40, $50 billion at a shot. These are just huge amounts of money, and that's important for these large pools of capital like central bank reserves, sovereign wealth funds. The other thing I think, so we've got the inertia, you've got the strength of the U.S. Treasury market, and the third thing I would put there is that there's no compelling alternative. If you're going to give me a better keyboard, it can't just be a little bit better than the QWERTY keyboard. It's got to be a lot better for me to make that transition. And I think that when you look around the world, I would maybe put it this way, that while the U.S. has its flaws, it's maybe like an ugly contest. Keynes thought the markets were a beauty contest. And the idea is to pick not who you think is the most beautiful, but to pick who everybody else is going to think is the most beautiful. In the foreign exchange market, I'm suggesting we have a bit of an ugly contest going on, and the dollar is somewhat less ugly than the other currencies.
So one last question I got for you. You've been generous with your time today. This morning I woke up and I saw in the news that Peter Thiel, I don't know if you saw this, he's
Sure.
talking about this idea that China could use Bitcoin as a financial weapon. So we don't really have to get into necessarily this idea, but what's your take on Bitcoin and its relationship with the US dollar and currencies? Do you see it as damaging? Do you, and even in the case of the US, do you think that we're going to see a major central bank step in at some point and buy Bitcoin? How do you view Bitcoin?
Yeah, so first I'd say that even the name Bitcoin, it reminds me of back in the day, there was before the Tea Party, there was a group in the United States that called themselves the moral majority. They neither were a majority nor were they necessarily moral. Bitcoin is money only because it says it is. What economists mean by money is a means of exchange, a store of value, and a unit of account. And I think that the Bitcoin, and that's not just my opinion, but people like Federal Reserve Chairman Powell, the head of the Bank for National Settlements, have basically said the same thing. Forget about Bitcoin being money. It is not being used for transactions, even though there's a payment system, a payment-like ecosystem being erected around it. But Bitcoin and the crypto space can be, though, it might be an asset. In my work, I will compare it to trees. What do trees do? I know from my green friends, trees are a great suck of carbon. You want to get rid of the carbon in the atmosphere? Grow some trees. Bitcoin, or crypto more broadly, I think does the same thing for savings. I'm told that the crypto market capitalization is about $2 trillion. Quite impressive. Where would that money be if it was not in the crypto space? It would be chasing equity markets to even more extreme valuations, or pushing down yields to more ridiculous levels. Like I mentioned, negative yields prevail in Europe and Japan. So I think that what crypto does is it siphons off the savings that would be going to chasing other things that we don't need, or extending valuation of the paper assets. So I'd have kudos for the crypto space for coming up with a new asset. I think it's oversold. It's like promises more than it can deliver by trying to think of itself as a challenge to the US dollar, or as even as a reserve currency. So I think there's a space for it. And people like, of course, I'm familiar with these arguments against the crypto space. Rubini, Thiel, who you mentioned, who I used to think was pro-crypto. But my sense is that a lot of them don't really, they dismiss it as money, and that's why they want to end the argument. Thiel's piece, his claim about China using it as a weapon, it's a nice, so for me, and I have to when I'm at my best, I think, it's sticking to the rigor of intellectual discipline. And so I make a sharp distinction between an assertion and an argument. It seems to me Thiel was really stringing a bunch of assertions together. How will China use this as a weapon against the U.S.? What are the really mechanics? When people say that the dollar is going to be replaced or be challenged by the Bitcoin, how? In the IMF is the most authoritative source for information on the reserve assets of central banks. They report it as COFER, C-O-F-E-R. You can find it on the internet, so it's publicly available. And what they report is at the end of every quarter with a quarter lag. So at the end of March, they gave us the Q4 of 2020. Central banks held a record amount of dollars. Over $7 trillion were in reserves. The dollar makes up more than half of the whole world's reserves. From 2018, if you give me 2018, from the end of 2018 through 2020, the use of the Chinese reserves, the Chinese currency as a reserve, went up by a little bit more than $200 billion. Excuse me, I should say that the holdings of China as a reserve asset is a little bit more than $200 billion. U.S. dollar holdings went up by more than $200 billion in the last 2 years. The proportions are just really out of whack. So for Bitcoin, imagine that this over $7 trillion held in reserves. Bitcoin is what, a little bit more than $1 trillion? Maybe it's $1.2 trillion, $1.4 trillion. Is it even close to be able to assume, even if it was money and all these other things were fair about it, is it really at all in the neighborhood of being able to absorb the responsibilities the dollar has? One thing I would suggest, again, going back to the treasury market, is reserves aren't just held in dollars. They're held in U.S. Treasury bonds, yield-generating Treasury bonds. What does Bitcoin give you? For me, I think that one of the problems is the volatility of it. So I will ask this question. I'm going to have this essay published shortly, I hope, and it sort of asks the question: how many Teslas will be bought with Bitcoin? Tesla says that they're willing to accept Bitcoin for cars. Fine. The MasterCard, Visa, PayPal are all expanding their facility to help make this possible. Say, so what? How many people are really going to buy their next car with a Bitcoin when they don't know what the Bitcoin is going to be worth? There's that story about maybe it's an urban legend, like the cat jumping into the microwave. But there's some guy who supposedly bought pizzas in the early days of Bitcoin with the Bitcoin. Really? Does that make sense? Does anybody want to be that guy? I don't think so.
That's a really interesting point, and I've heard that from a few friends where the first time that Bitcoin ran, it was everybody running around saying it's a currency. This time it's an asset, and the only reason to buy Bitcoin is because you think it's going to go up. There's no real utility beyond that. Would be sort of
sounds like my stock account. I buy stocks that I think are going up.
That's a good point. So, Marc, where can our audience find out more about your writing or your content if they want to learn more about sort of your ideas and your commentary?
Thanks a lot for that opportunity. I even though I spent my career working with these large asset managers, these large corporations, from my early days on the floor of Chicago Mercantile Exchange, I've really have a lot of respect for retail investors who have their own skin in the game, who, unlike, during the great financial crisis, there were these things called ninja loans made for people with no income, job, or assets. And this is what you can do when you're using OPM, other people's money.
Yeah.
So I try to make my stuff, my commentary, my analysis, I'm really committed to making it available to retail investors. So I get an agreement from my employers to post my commentary on a publicly available blog, no advertisement, no fees. The blog is called Marc to Market. Marc with a C, unlike for my name, unlike the accounting rule. And I'm also on Twitter. I find I was kind of slow beginning at Twitter, but I've been on for over a decade now, and I find that for short, preferably witty, insight into the market, that I find Twitter helpful. I also use it as my news aggregator. So I'm there at Marc Making Sense, which is really just a play on my first book that was published by Bloomberg called Making Sense of the Dollar. And that's not sense like in money, but sense like common sense. And I have another book out called Political Economy of Tomorrow. I had in graduate school in American history, I studied this one guy views. His name was Charles Conant. And you know that the Chinese Belt Road Initiative? Well, I think that this guy, Charles Conant, invented it for the U.S. to have a huge global infrastructure project in the late 1800s, early 1900s. It turns out that Charles Conant ends up working 100 years before me at the same bank, Brown Brothers. And so I take a look at this Political Economy of Tomorrow. It's really a book. The first book about making sense of the dollar was really just a culmination of my career in the foreign exchange market. But the Political Economy of Tomorrow is really more like a sort of like a child of love, in the sense that I've been working on these ideas for 30 years, and I finally found a way to consolidate them and to show what it means for America and the future.
Okay, well, Marc, thanks so much for taking the time to come on today. We really appreciate it, and I'm sure we could talk to you for hours. So hopefully you'll come on again in the future, because you've given me a lot to think about, and like I said before, we're generally micro cap sort of balance sheet income statement guys. So for us to understand how all these macro components work is really valuable to us.
Well, when you find out how they really work, you got to let me know.
Awesome. Thanks so much, Marc. Really appreciate you coming on.
Good luck, guys.
Okay, so that was fun.
That was great.
I could tell every now and then you hop on and you've got a whole bunch of. I noticed one of my TVs turned off on me on the back. Where you get really engaged and you're interested.
It happens every now and then. I'm sure I could have done that whole interview myself and then some. My issue, I know, is I like to get into the weeds of things, because that's where I really start to understand things, where you like to keep things so high level that I'm always left with 1,000,001 questions. So different approach. It's all right.
Yeah. So what's in the news today that you want to get into?
Oh, I think you know what we got to get into here.
Is this the big cannabis acquisition that was announced today? Supreme acquired by Canopy? Is that what you're talking about?
Yeah.
Okay, let me pull it up here. I'm assuming that you covered this news at the deepdive.ca?
Of course I covered it.
Why'd I even ask? So
every now and then there's a news release that doesn't matter what you're doing. It's a non-optional news release. You drop everything and you go. thankfully that this one came out this morning, and we were able to cover it right on time.
So let's get into this here. I'm just going to put the headline up. For some reason, when I did my pre stories, I didn't put this one in. And the second you're like, well, what story do you want to cover? I'm like, why didn't I put that in? I'm just getting caught up here. Okay, so here we go. Supreme Cannabis to be acquired by Canopy Growth for 44 cents. Jason, take it away.
So the latest garbage acquisition being conducted by Canopy Growth is that of Supreme Cannabis. Our title says 44 cents per share. That, to be clear, is largely based on it's mostly an all-share transaction for some awful reason. If you hold a share of Supreme, you'll be getting 0.01165,872 shares of Canopy plus 0.0001 of $1 in cash. Why that cash component is there, I will never understand. I think that's perplexed people just as much as why Canopy's buying any more cultivation space in Canada. I mean, largely, let's face it, this is because of Aurora Cannabis. Notably, Canopy will be losing its position in terms of market leader once that acquisition closes, and I think it's 6 days from now. Supreme Cannabis, John Fowler is a great guy. Of course, he's no longer there. He founded it. He was very, very focused on that the quality of the cannabis he put out, not so much on the equity. He has publicly said that, and I mean him no disrespect by what I'm about to say, but so many shareholders have lost money on this deal, largely because they were so focused on the operation rather than the equity, and they continually diluted this thing. The amount of shareholders that are big holding well above 44 cents, I'm sure, is out of this world. This thing was notably priced much higher before it had its license compared to when it actually achieved it. They did something like a $200 million convertible debenture, where I'm pretty sure that converted at a higher price as well. So there's just all kinds of people that are probably just pissed this morning because their worst nightmare came true, in that they're taking a massive loss on this transaction. Now, to be clear, Supreme was at 26 cents, so anyone that bought yesterday for the last few months actually did quite well with this. But my question really is, why the hell is Canopy buying more cultivation space in Canada? How many facilities have they closed in the last year, 2 years? Like, it's insane. And one of the selling features they said is they get a new production facility. Great, so it's another facility that Canopy is just going to close down. I mean, I get that they're looking to gain recreational market share. Let's face it, Aphria/Tilray was off the table, and they were second best in the market, if not best when you factor in quality. Aurora Cannabis is a dumpster fire, and it has been for years. I don't know how that thing's still in operation. Hexo is going to die a slow, painful death with all the debt it's bringing on with Zenabis. They do have some stuff with Molson, but even Molson didn't want to actually invest in them. Rather, they just joint ventured. Organogram's having debt called by BMO, and they just signed with British American Tobacco. So they have no desire to go with Canopy. Who's left, right? So they went to Supreme.
I'm actually chatting with the cannabis company at 2 p.m. on SmallCapSteve Live. If you're around, would love to have you guys join us. A new company who started trading today. But look, guys, I've always been critical of Supreme. I didn't like how they loaded their cap structure with convertible debt. Just didn't seem like it was ever going to work out well. I actually think 44 cents a share, based on what it was looking like at one point, actually sounds pretty good.
I mean, let's face one thing.
What was it trading at like a week ago?
Yesterday is at 26.5 cents. It's kind of stayed around there. But I mean, let's face it. Current shareholders, this is the best they were going to get. Absolutely, I get that. My main thing is, what the hell is Canopy doing? This just doesn't make sense. Like, sure, you're looking for recreational market share in Canada, but Canada is so small. Why are you wasting your money and your cap structure expanding in Canada when the US is just around the corner, right? It doesn't make sense. And I'm 99% certain that David Klein, CEO of Canopy, has said They're not looking to do any acquisitions in Canada yet. What, 2 weeks ago they did Ace Valley. Today they did Supreme. You got to wonder what's going on in that boardroom.
So here's the 2-year chart for Supreme. You can see here 2 years ago it was trading at $2, and it's been downward ever since. It hit sort of a low there of what appears to be about 13 cents. It's come back up, and it looks like it's going to get taken out for 44 cents in an all-stock transaction.
Well, not quite. There's a couple pennies being added.
Is it like 0.01 cents?
Yes, 0.01 cents. Yes. I mean, 435 million, outstanding that Supreme managed to get that, because let's face it, that's going to be written down to below 200 million in 12 months. This is going to be like a Hexo News Strike deal where in a year it might not even be on the balance sheet, right? Canopy loves to take massive losses, and this is just going to be another instance.
Yeah. So here, let me pull up the most recent. This is for the 6 months ended. They got one of those weird fiscal years. And I just want to pull this up here and just sort of say, okay, we look at the balance sheet here. Okay. This is expressed in thousands. So they did have 20 million cash on the balance sheet there.
Offset by payables and accrued liabilities of 13.2.
Yeah, 13 million in payables, 6 million of the current long-term debt, 50 million long-term debt. Was this, how much of this debt was, like, what was the structure of this debt? I guess I could go down to note 11 and we could do live on air equity.
I apologize. Offhand, I don't remember. I also see that there's convertible debt on there, and I thought they got rid of the convertible debt. So that's even more interesting.
This is as exciting as it gets, folks. On November 14th, 2019, the company entered into a credit agreement with a Tier 1 Canadian bank, acting as a lead arranger and agent on behalf of a group of lenders for $90,000, I assume that's $90 million, of senior secured facilities consisting of a long-term loan of $70 million and a revolving credit of $20 million.
So you want to know what the big story here is?
Go for it,
The big story is BMO is looking to get out of cannabis. By all accounts, that's what it looks like. We saw them it might have been earlier this week, actually. No, it was last Thursday, right before the long weekend. Organogram Holdings just quietly said, oh, hey, by the way, we paid off our debt. That's not something you put out on a Thursday after market unless you didn't actually want to settle that debt. It was held by BMO. BMO got out. BMO was heavily involved with Supreme as well. Now you see this deal come as if BMO saying, hey, we're calling this pretty soon here, so you might want to figure out an exit strategy. Of course, I don't have anything hard evidence, but I will have an article out this weekend on BMO and their latest actions in the cannabis space.
I've seen some stuff with some cannabis companies that tells me that there's a lot of very interesting mechanics going on in the background whenever we see that these Tier 1 banks are investing in these companies. Because you'd think, like, if you had access to $40 million of Schedule 1 bank debt, that's, standard bank financing, you'd be able to make it work. But let me pull up the cash flow statement here for Supreme. You know how much I love cash flow.
The cash flow statement wasn't as bad as I thought off memory.
It's still not good, though.
It's still not good. I mean, let's face it. They've been in the business for we're in rec. We're on the third year of full rec, are we not?
They're paying $435 million. Canopy, sorry for interrupting.
No.
But Canopy's paying $435 million cash for a company that's losing $3.5 million in operating cash flow every quarter. And yes, that has improved. This time a year ago, they were based on like the quarterly rate. They were losing about 7.5.
No. Quarterly a year ago would be 15.
Sorry, 15. So they have So they've gone from 15 to 3.5. Okay, so that's great and all, but you're paying $435 million for a business that doesn't make money in a market that is getting continually more competitive. What's the expectation here? Is there? Do they have some sort of asset that Canopy doesn't have? This company that's bought up almost everything.
Well, just scroll up to assets. Let's do the quick math on what kind of assets they actually bought. So Supreme saying they have 276 in assets and liabilities of 93. So, like I said, under 200 million in net assets effectively there, and they're paying 435 million. This thing's going to be written off in a year. This is not going to pass any sort of audit test for Canopy.
Yeah, I don't look. I think that every Canadian cannabis company is uninvestable. The only one that I find kind of interesting, I don't know if they're still a client of ours or not, is Willow Biosciences, just because I think that that's a big enough story that it can get on the NASDAQ, and it's just not a cash burner like they're trying to prove out biosynthesis. I'm
actually going to I'm going to disagree with you a bit.
Okay.
There are good operators in Canadian cannabis, but I'm not going to say that any of them are public.
I'm talking about from an investment standpoint.
From an investment standpoint?
From a public market standpoint. None of these merit investment if you are a retail investor. Period.
Yes.
Name me one.
Yes, I would say Willow, but I don't. They're cannabis, but they're actually biotech. So when I say cannabis, I'm thinking they have products on the shelf at a retailer.
Like,
right.
If when I talk to companies that are in the space now and they're saying like, can you help us out? Can you help us tell our story? I say to them, guys, I can't do anything for you right now. All you can do is execute and prove it. You do it. You know, I got a big platform. I could go out and I can let everybody know that you've executed. But I'm telling you right now, the ball's in your court to execute, because nobody wants to hear it anymore. Nobody wants to hear that you're going to be generating 35% EBITDA margins on $1 billion revenue based on your pipeline of opportunity in Europe. Nobody gives a shit. You want to actually get investors to come and buy your stock at this point in 2021? You've got to find an actual path to profitability. And the challenge is that even if you are a great operator, like let's put the valuation in the public vehicle aside. If you're a great operator, you could probably go in and, you know, maybe make a company make a little bit of money. That does not mean that you are going to make this valuation make sense. So the challenge I have when I look at this isn't necessarily that I'm saying that all the operators are crap. The actual individuals who are operating these businesses, those on the floor, who from the people who are setting the schedules, making sure that the HR people who are making sure that they have the right staff in place, the people in trim rooms who are cutting up cannabis, not talking about any of them. That's clear, especially on this show where we talk about equity analysis. I'm talking about from a straight up valuation standpoint. It is a show me time. If you're a Canadian operator, you got to show us that you can generate positive operating cash flow, or else the rest of us just kind of scoff and go, well, that don't make any sense.
You know what I'd truly like to see? Now that we've seen all this garbage in terms of public cannabis in Canada, I would like to see the operators that have been slugging it out for 3 years privately, that are generating genuine income, and I mean net income in all respects. That includes their cash flow positive. There has to be some out there. I don't care about the size. Like, even if you're small and you have $5 million a year in revenues, now's the time to go public if there's a chance you can actually scale your business and remain along similar lines in terms of cash flow positive. Because that would be such a differentiator. And like, there has to be private operators that are actually doing that, because otherwise, why would you stick around?
Sure. But for this show's standpoint, we're talking about retail investors that are like, look, there's people out there that are real operators who went out and they got a cannabis license, they raised some capital, and they started generating actual cash flow. I'm sure that those exist in Canada. Like, for example, we've heard of certain stores that generate tremendous cash flow and EBITDA in Toronto that had early licenses for retail. But I mean, it's very different than what, you know, we look at on the show.
Oh, absolutely.
Which is
absolutely
companies who told a big story. Like, this would be like, you know, I used to run an online school where students would come and take math courses with me. I could have easily gone out and raised a ton of money and told a big story there. I chose not to. I decided I wanted to get back into the investing game. So that was the path I ultimately took. But I could have ran around and told everybody that, you know, I was going to hit, you know, $100 million revenue in 3 years. And this is the path, and tell that big story. But, you know, if the name of the game is selling stock, right? It's no longer actually operating a business. Then Bruce Linton's great. Bruce Linton tells a good story, does lots of acquisitions and gets people fired up. And then you try to hire groups like us who have platforms to talk about your story so that people can get amped up and excited. But at the end of the day, cash flows do matter. you can't run on fumes forever. And, these stories that they were telling to the sell side analysts and the investment bankers and everybody who was in on it that had the cheap paper that then tried to go and get retail investors to buy, it caught up with them. These guys were all supposed to be doing hundreds of millions of dollars in Europe by now, were they not?
Oh, it's hard to even keep track of all the garbage, right?
It'd be a fun experiment to go get some of the sell side analyst reports that Matt Bottomley was putting out 4 years ago and compare them to where we are today.
I know you singled out Canaccord there, but let's face it, everyone did it.
Okay, Canaccord's the top dog.
Absolutely. I know why you pulled Canaccord. Canaccord's easily the top dog in the sector.
You're going to put pen to put these ridiculous assumptions. Then yeah, I mean, if it doesn't work out, that's part of being an analyst. You get paid to make these assumptions. Obviously, if you're on the sell side, I don't suggest anybody take sell side projections seriously. That's why I don't even like to do that because you don't know. I mean, you could do it internally, but externally, when you're trying to sell equity, I mean, this is a whole nother discussion. And I mean, my favorite ones are looking at some of the sell side guys on Tesla. That's a lot. That's probably even funnier. But let's wrap it up here because SmallCapSteve's got a busy day. He's coming back on the air at 2 p.m. I've got my calendar's full. I worked till 10 p.m. last night. My calendar's full the rest of the day. So Jay, give it to me straight. You got any interesting content coming out on the deep dive later today?
Well, I am perpetually behind this week because we are growing, and I've been training staff and everything else. So this afternoon, we've got Lobo T. Gray of the Independent Speculator on the Daily Dive. After that, I have zero scheduled. I barely got Lobo scheduled before we hopped on the show. So it's a surprise for you and I.
Okay.
Outside of that, I've got several good stories that we are working on. And I will have something out on, I apologize. I don't know how to say this. Oh, feedback. A or Can. I will have something out on them in the next hour and a half, probably. Right as you're live, most likely.
Okay, and sorry about the feedback there. We're just working on some technical difficulties. Look, guys, you could have spent your last hour anywhere in the world. You chose to spend it with us. I appreciate that. But before I even get into my appreciation, I've got to talk a little bit of disclaimer language. Nothing we talk about on this show is a buy or sell recommendation, which I don't think we really even say that, but just to be clear, we talk about something. We're not telling you to buy it. We're not telling you to sell it. This is for entertainment, informational purposes only. If you're looking for financial advice, go find somebody who's licensed, not us. Do not sue us for anything we say. This is for fun. Marc Chandler was great today. I really appreciate Marc coming on. That was entertaining. JTD saying that the Jays broke his heart in Texas. I agree, JTD. He also is telling me that I got to check out EGT on BNN after the show. Iguana Justin Holland was on BNN Bloomberg. It's Justin gets on SmallCapSteve Live. That's kind of the big thing that happens here. BNN, okay, I'll give it to you. Look, you could have spent your last hour anywhere in the world, staring at any screen, any place. But you chose to spend it with us. Me and this guy.
Right here.
And I sincerely appreciate that. We got the great Turd Ferguson hopping on tomorrow. Craig Hemke. That's going to be a fun show. Craig is great, and I'm sure he is going to be all riled up over Janet Yellen trying to tell countries around the world that they can't take their tax rate lower than the U.S. So that will be a hoot. We will see you all at 2 p.m., but the main show tomorrow at noon with Craig Hemke. Thanks for joining us, everybody.
It all went up the mountain and it wasn't hard to climb at all. At the top I found some relief, you see, so please don't